Bank of England has issued a new financial stability report, which they do every quarter or so, and this one is important because it says one overwhelming thing, which is that the risk environment around the UK economy has deteriorated.
3 weeks ago, something quietly slipped past the news cycle, a document from the central bank that should have led every bulletin in the country. It wasn't dramatic, it wasn't flashy, but buried inside those 57 pages of dry, technical wording was a message so alarming that I genuinely stopped, reread it, and asked myself, are they actually saying what I think they're saying? According to the central bank, the entire financial system is sitting in a fragile place. They're seeing households drowning in debt, commercial properties showing real signs of trouble, and a combination of risks that could hit all at once. The kind of chain reaction that doesn't just shake markets, it rattles everyday life. And remember, this isn't some YouTube commentator guessing. This is the very institution responsible for keeping the system stable. They choose every word with legal caution, so if they are sounding uneasy, it's because they're genuinely worried. Stick with me because by the end of this video from UK Economy Explained, you'll know exactly what they're picking up on behind the scenes, why their calm tone is hiding a much sharper concern, and, most importantly, what steps you should take now before these warnings turn into real-world consequences. Central banks never issue alerts for entertainment. They only do it when they see pressures building that they might not fully control. And they never speak plainly. They speak in coded, careful phrases designed to alert without sparking panic. So when a central bank says the system is vulnerable to severe stress, that's their polite way of admitting, look, there are multiple paths this could collapse, and we're not sure we can stop all of them. When they say risks might appear at the same time, what they really mean is, if a few things break together, the entire system could be overwhelmed. And when they suggest household debt needs close monitoring, that's the soft official translation of, people are stretched to their limit. One wrong turn and we're facing a wave of defaults. This is exactly how you read central bank language, and exactly why this warning matters far more than it appears on the surface. Institutions never shout, a crash is coming, even if they believed one was on the horizon. Saying that out loud would spark the very crisis they're trying to avoid. So instead, they use cautious phrases like vulnerabilities and heightened risks. In central bank language, that's basically their way of whispering, we're seriously worried. So let me break down what these warnings actually mean in clear, plain English right here on UK Economy Explained. Warning number 1. The household debt time bomb. The official report mentions elevated debt-to-income ratios and smaller payment buffers. Here's what that really means. Families are borrowing far more than they can handle. Debt levels are close to the highest we've ever seen, and millions of households are pouring nearly half of their monthly income into rent or mortgage payments alone. People who locked in ultra-cheap mortgages at 5% or 2% were able to manage comfortably. But once rates jumped to 5% or 6%, those same payments turned brutal. And the central bank is looking at one number in particular, the 2 million households who had to refinance in the last 2 years. Many of them saw monthly payments jump from £800 to £1,600. That's nearly £10,000 extra every year, wiped straight from their budget. How did they survive it? By cutting everything that's not essential. No holidays, no savings, no cushion. Many families are living so close to the edge that a single emergency, a car repair, a medical bill, anything, could tip them into missed payments. And it's not over. Another one. 5 million households are scheduled to remortgage within the next 18 months. They're still on old low-rate deals, but once those expire, their payments will shoot up too. Some families will manage. Many won't. Here's the part the central bank doesn't say directly. If even 10 to 15% of these households start falling behind, banks begin taking real mortgage losses. Once banks get nervous, they tighten lending. When lending tightens, the economy slows. As the economy slows, more people lose jobs. And lost jobs lead to more missed payments. It becomes a downward chain reaction. Warning number 2. The commercial property crisis. Nobody wants to talk about. The official line says there are pressures in commercial real estate and that valuations are adjusting. Translation. The commercial property sector is in deep trouble, and banks are deeply tied to it. Office buildings in major cities have been hammered by remote work. A building that fetched £20 million before the pandemic might struggle to sell for £12 million today. That's a gigantic drop, around 40%. In some cases, even worse. Why does that matter? Because banks lent huge sums against those older, higher valuations. If a bank handed out a £15 million loan on a building they believed was safely worth £20 million, they had a comfortable buffer. But now that same building is only worth £12 million, and the loan is still £15 million. That gap becomes the bank's problem. When the value of a building drops below the size of the loan attached to it, the bank ends up in a losing position. Now imagine that happening across the entire commercial property market. That's exactly what's unfolding. Banks are holding stacks of loans that no longer match the real-world value of the buildings backing them. And because rental income has collapsed in many areas, landlords are already struggling to keep up. Some have stopped paying altogether. When that happens, the losses land straight on the bank's balance sheets. The central bank has quietly hinted that these commercial real estate losses could eat into bank capital to a worrying degree. That's not a small issue. If a bank's safety buffer shrinks too much, the only option they have is to slam the brakes on lending. Not because they want to, but because the rules force them to protect their capital ratios. Warning number 3. Global pressure points. The report uses calm phrases like elevated global debt and spillover risks, but here's what that really means. Trouble anywhere in the world can hit the UK like a shockwave. Our financial system is tied into global markets more tightly than almost any other country. London is one of the biggest financial hubs on the planet. UK banks operate in dozens of countries. Trillions in foreign money flows through our markets every year. That's a strength in good times. It means opportunity, investment, and growth. But when something goes wrong overseas, that same connectivity becomes a highway for chaos. Issues in American commercial property, a banking wobble in Europe, or a breakdown in China's property sector. Any one of these can send stress rippling into the UK in a matter of days. What the central bank is really saying is this: we're watching several unstable situations developing worldwide. We don't know which one will break first. But if any of them crack, the UK will feel the impact immediately, and we might not be able to shield the system. And that brings us to the flashpoints they're worried about. These aren't vague theories. These are specific weak spots where the system could snap. Breaking point number 1. The mortgage squeeze. Here's the scenario they're quietly preparing for. Over the next 12 to 18 months, another one. 5 million households will roll off their cheap fixed-rate mortgages and face new rates that are 2 or 3 times higher. Suppose even 15% of these families, around 225,000 households, simply cannot afford the jump. They begin missing payments straight away. Banks try to help at first, extending terms, offering temporary pauses, doing everything they can to avoid repossessions. But after 6 months, after a year, there's no room left. They start the legal process. Now imagine 225,000 homes being pushed into the market as forced sales over just a year or so. That's a tidal wave of supply. Prices fall, maybe 10%, maybe 15%. And once prices slide, people who bought recently with tiny deposits fall into negative equity immediately. Someone who scraped together a 5% deposit 2 years ago is suddenly holding a mortgage bigger than the value of their home. When a homeowner's property falls below the size of their mortgage, they're trapped. Selling means taking a loss they simply can't handle. At the same time, falling home values make banks nervous. They respond by tightening lending rules. Mortgages become harder to get. Demand drops. Prices drop further. More homeowners find themselves underwater. Defaults climb. This is the classic housing crash scenario, and it doesn't need some shocking, unpredictable event. All it takes is what's already happening. Hundreds of thousands of households facing higher rates and a significant chunk unable to keep up. Breaking point number 2. The commercial property domino. Here's how this one plays out. Commercial property values continue to sink. Rent stays low because businesses need less office space than before. Property owners struggle to cover loan payments. Many eventually walk away, leaving the keys to the banks. Now banks own buildings they don't want, buildings worth far less than the loans they made. Losses pile up. To protect themselves, Banks pull back from lending. They won't refinance maturing loans. They won't provide new financing. Credit dries up. Properties that need to be sold hit a market with almost no buyers who can get funding. Prices crash further. More owners default. More banks lose money. The cycle spins faster and faster. And this is where it becomes systemically dangerous. Some banks are heavily concentrated in commercial property lending. If losses are severe enough, their solvency could be threatened. Suddenly, other banks start worrying about exposure. Interbank lending freezes because nobody trusts anyone else's balance sheet. Credit across the economy grinds to a halt. This is the banking crisis scenario. And here's the kicker. It doesn't require fraud, exotic derivatives, or the kind of dramatic shocks we saw in 2008. All it takes is too many loans backed by assets that have lost too much value. Breaking point number 3. Global contagion. Now imagine the trigger coming from overseas. Maybe it's regional banks in the US under stress. Maybe it's European institutions struggling with their own property exposures. Maybe it's Chinese developers defaulting on debt. The exact origin doesn't matter. Trouble abroad can travel fast, and the UK is extremely vulnerable because of how tightly our financial system is linked to global markets. The central bank is essentially warning us. It doesn't take a domestic shock alone. A crisis starting anywhere in the world could reach London's banks in days, amplifying risk, and there's no guarantee the UK can stay insulated. What really matters is how problems travel. A shock in one major financial hub doesn't stay there. London's trading desks are connected to New York, Frankfurt, Hong Kong. When selling starts in one place, it hits everywhere. UK banks are tangled up internationally. They've lent to foreign borrowers, hold foreign assets, and have counterparty deals with institutions around the globe. When those overseas positions wobble, UK banks feel the tremors immediately. Suddenly, stress pops up in multiple markets at the same time. Bond yields spike, credit spreads widen, stock markets drop, currencies wobble. Every signal that measures financial strain starts flashing red. Money flows to safety. Investors pull out of riskier markets, including the UK. The pound drops. Inflation rises. Interest rates stay high. Mortgage stress deepens. Commercial property problems worsen. Domestic issues amplify each other. This is what the central bank would call a compound crisis. Multiple failures feeding off each other, spiraling out of control. And their ability to respond? Limited. They're fighting fires in several places at once with fewer tools than before. So why are these warnings coming now? Why publicly signal concern? Reason 1. Their tools are constrained. Think back to 2008. Central banks had plenty of levers to pull. Slashing rates to near zero, buying bonds by the billions, pumping liquidity into the system. Those days are mostly gone. Rates are already above 4%, and inflation is still too high to cut aggressively. Their balance sheets are bloated from past crisis interventions. Doing more bond purchases now would look like printing money to fund deficits. A credibility nightmare. The message here is clear. We can see trouble building, but we don't have the firepower to respond the way we could before. That's not optimism. That's a red flag. Reason 2, risks are clustering. It's not just one problem. It's a series of potential shocks happening at the same time: housing stress, commercial property losses, international contagion. Each risk feeds into the next, compressing everything into a tight, dangerous window. That's exactly what central banks are worried about. Multiple problems, all interacting, all straining the system. Over the next 18 months, households face a mortgage refinancing shock. Commercial property stress isn't just ongoing. It could get worse. International vulnerabilities, from global debt to geopolitical tensions, are simmering. Inflation remains high, limiting the central bank's ability to respond. Economic growth is weak, making it harder for the system to absorb shocks. Any one of these might be manageable on its own, but when they all converge, that's a compound crisis. Multiple things breaking at once, each making the others worse. The central bank isn't speaking hypothetically. Their stress tests model exactly this: multiple risks happening simultaneously. And in some simulations, the results are stark. They're essentially saying, we've run the numbers. When multiple shocks hit together, the system struggles. The likelihood of several things going wrong at once? Higher than normal, and that's why they're sounding the alarm. Reason 3. Time to build resilience. One purpose of publishing these warnings is simple. Give people and institutions time to prepare. Banks can raise capital. Households can build savings. Businesses can reduce leverage. These things take months, sometimes years. By signaling now what could happen over the next 12 to 24 months, the central bank is giving everyone runway. Reduce debt. Save more. Diversify assets. Prepare before the crisis is obvious, because by then, it's often too late. So, what are the people with inside knowledge doing? Let's break down the moves of sophisticated investors and institutions. Action 1. Reducing UK exposure. Data shows foreign investment in UK assets is declining. Institutional investors are trimming positions in UK commercial property. Some are selling government bonds. This isn't panic, it's calculated risk management. These investors are not exiting entirely. They're adjusting positions to a level where losses, if the market falters, remain manageable. Essentially, they're positioning themselves ahead of the crowd. Action 2. Holding more cash. Fund managers are keeping higher cash balances than usual, 10 to 15% in cash or equivalents. Why? Because in a crisis, liquidity is king. Cash allows them to seize opportunities when asset prices drop, and avoids forced selling at bad prices due to redemptions or margin calls. High cash levels are a clear signal. The smart money expects volatility, and they want flexibility. They're not fully committed to current market prices, giving themselves options when the storm hits. They're keeping their powder dry, waiting for better opportunities to appear. Action 3. Shortening duration in the bond markets. Smart investors are reducing duration, that is, lowering the sensitivity of their bonds to interest rate swings. They're selling long-term bonds and holding shorter-term ones. Why? Because if yields spike, long-term bonds lose value faster. Short-term bonds move less. This tells us they're positioning for possible financial stress. They're willing to take lower returns now to reduce the risk of big losses later. Action 4. Buying credit protection. Another move is buying credit default swaps, basically insurance against defaults. Prices and volumes of these contracts have been rising, signaling that sophisticated investors expect higher default risk. Buying protection costs money, but if defaults hit, it pays off significantly. This isn't panic. It's a calculated hedge. They're paying a premium today because the risk of problems tomorrow has increased enough to justify it. So now you see the warnings, and you see what the smart money is doing. What about your playbook to protect yourself? Personal action 1. Build maximum emergency savings. If you don't already have 6 months of living expenses in cash, make this your top priority. Trim discretionary spending and redirect everything you can into this safety net. Why 6 months? Because in a crisis, it might take that long to find a new job. If mortgage payments become difficult, having a buffer gives you leverage with your lender. If market stress and assets drop in value, having cash allows you to wait it out without selling at a loss. This isn't about chasing returns. Cash earns almost nothing. But during a crisis, not being forced to sell or borrow at high rates is far more valuable than any interest you could earn. Personal action 2. Minimize variable rate debt. If you have variable rate debt, credit cards, personal loans, or mortgages, either pay it down or lock in a fixed rate where possible. In a financial stress event, interest rates can jump quickly. Reducing exposure protects you from skyrocketing payments and helps maintain financial stability when the unexpected hits. Variable rate debt can get expensive fast. Fixed rate debt stays predictable. That stability is invaluable. If your mortgage or loan is on a variable or tracker rate, seriously consider switching to a fixed rate, even if it feels high today. The protection against further rate spikes is often worth the cost. And if your mortgage deal is coming up for renewal within the next year, start exploring options now. Don't wait until the last minute. Action 3. Diversify beyond UK assets. If your investments are mostly UK-based, UK stocks, UK property, UK bonds, you're concentrated in exactly the assets that could underperform if these warnings play out. Diversification is your safeguard. Look to international stocks, foreign currencies, and assets less tied to UK performance. Globally diversified funds are an easy way to achieve this. They spread risk across countries and sectors. You don't need to predict which economy will outperform. The key is not having all your eggs in the basket that might drop. Action 4. Stress test your finances. Take a hard look at your personal situation. Ask yourself, if I lose my job, how long could I survive on savings? If my mortgage payment jumped 50%, could I manage? If my property fell 20% in value, would I be underwater? If my investment portfolio dropped 30%, how would that affect my retirement? Run these scenarios honestly. Identify where you're vulnerable. Then take action. Build more savings, reduce debt, adjust your investment mix, or improve your employability. The goal is to know your weak points now, while you still have time to strengthen them, rather than discovering them in the middle of a crisis when it's too late. Action 5. Diversify your income. If all your income comes from a single employer or sector, property, financial services, retail, hospitality, consider building alternative streams. This could be a side business, freelance work, investment income, or skills that let you work in multiple industries. The aim is simple. Don't be reliant on one source of income if that sector faces a shock. If one source of income disappears during a crisis, having another stream gives you a cushion. It doesn't need to replace everything. Even partial backup helps you ride out shocks. Action 6. Stay liquid and flexible. Don't tie up all your money in illiquid investments. Property, long-term fixed deposits, or funds with withdrawal restrictions. Flexibility is a form of protection. Being able to move quickly when opportunities or risks appear can be more valuable than the slightly higher returns you'd get from money that's locked in. Keep a meaningful portion of your assets in things you can access and sell quickly. In a crisis, options are everything. Now, the question everyone asks, when does a warning become a crisis? What's the timeline? The honest truth? Nobody knows for sure. The central bank is flagging vulnerabilities and risks, not issuing a calendar for disaster. Financial crises don't follow a neat schedule. What we do know is this: the risks they're highlighting are building over the next 12 to 24 months. Mortgage refinancing shocks will roll out as fixed-rate deals expire, ongoing through 2026. Commercial property stress is already here and likely to continue. Global vulnerabilities exist and could hit at any time. So the window of heightened risk is roughly now through late 2026. During that period, a trigger could spark a crisis or nothing might happen. These are probabilities, not certainties. Here's the crucial point. The central bank doesn't issue warnings like this lightly. They are cautious, conservative institutions that avoid creating panic. If they're publishing a public warning, they genuinely believe the risk is elevated enough that people should prepare. Treat this 12 to 24-month period as your window of heightened vulnerability. It's not a guarantee of crisis. It's the time when risks are at their peak and triggers are most likely. Planning and positioning now gives you the best chance to navigate whatever comes next. The central bank is sending a clear signal. Serious vulnerabilities are building in the financial system. Household debt is high enough to spark widespread defaults. Commercial property stress could hit banks hard. Global risks could spill into the UK. And these issues aren't isolated. They could cluster together, creating a true compound crisis. Why are they warning now? Because their tools to respond are limited. Multiple risks are emerging at the same time, and they want to give institutions and individuals time to strengthen their defenses before any problems materialize. The smart money is already moving, trimming UK exposure, holding more cash, shortening duration on bonds, buying credit protection. And for you, your playbook is clear. Build emergency savings, minimize variable rate debt, diversify beyond UK assets, stress test your finances, consider income diversification, and keep money liquid and flexible. Is a crisis certain? No. But is the risk elevated enough for the central bank to go public with these warnings? Absolutely. These alerts aren't for entertainment. They're issued when the institution responsible for financial stability sees trouble on the horizon and wants people to prepare. If you want ongoing updates and analysis of these financial risks and what they mean for your money, hit subscribe. Think of central bank warnings as the canary in the coal mine. When they speak up, it's time to pay attention. The warnings are out there. Now you understand what they really mean and how to act. The question is, will you prepare while there's still time, or wait until everyone else realizes the risk? When it may be too late. Stay alert. Stay prepared.